It wasn't even the global pandemic. The idea that risk could be dissolved by a printing press. But history calls it something else: debasement. The pattern is unmistakable. The arithmetic is merciless. We are told that bailouts keep the system alive, that without intervention, the wheels of commerce would grind to a halt, that the government is the insurer of last resort. But what if the insurance policy is the very thing burning down the house? What if the medicine is actually the poison? The pattern we are seeing today is not a modern invention. It is not a product of complex algorithms or high-frequency trading. It is the oldest story in the history of money. It begins with a golden age of dominance. It evolves into a period of overextension. It triggers a crisis of affordability, and it ends with a choice between immediate pain and a fatal shortcut. Every empire faces this moment. Every currency faces this test, and almost without exception, they choose the shortcut. They choose the bailout. They choose to print today. We attribute this logic to John Maynard Keynes. We call it Keynesian economics. The idea that the state must step in to smooth the business cycle, to fill the gap in aggregate demand. But Keynes did not invent this behavior. He simply gave it a respectable name. He provided the intellectual cover for the political impulse to survive at any cost. The incentive is powerful, the payoff is immediate, the risk is hidden in the future. Under these constraints, the rational move for any politician is to delay the reckoning, to kick the can, to pretend. That debt is wealth, but the timeline is finite. The bill always comes due, and when it does, the cost is not paid in money. It is paid in social order. It is paid in the destruction of the middle class. It is paid in the collapse of trust. We are going to examine this pattern through the lens of history. We will look at 3 specific empires that tried to bail out their way to stability. We will see exactly how they did it. We will see who paid the price, and we will see where it ends. This is not a forecast. This is a forensic accounting of the past. The pattern repeats. The mechanics are identical. The outcome is fixed. Transition to standard narration. The first case study takes us back nearly 2,000 years to the definitive model of imperial overreach, the Roman Empire. Specifically, we must look at the crisis of the 3rd century, but the seeds were sown much earlier, during the reign of Nero. We often think of Roman decline as a story of barbarians at the gates, but the true collapse began in the counting houses and the Chichon mints. The Roman economy was built on conquest. New territories brought new slaves, new gold, and new tax revenues. But eventually, the expansion stopped. The borders calcified, the flow of easy plunder dried up. Yet the costs of maintaining the empire, the legions, the bureaucracy, the grain, dole for the citizens of Rome, did not stop. They grew. By the time Nero took power in 54 AD, the fiscal mathematics of Rome were already straining. Nero faced a problem that would be familiar to any modern central banker. He had massive obligations. He had a populace that demanded entertainment and bread. He had an army that required constant payment to prevent mutiny. And following the Great Fire of Rome in 64 AD, he had a massive infrastructure bill to rebuild the capital. He could have raised taxes, but that risked rebellion among the wealthy senators. He could have cut spending, but that risked riots among the plebeians. So Nero chose the third option. He chose the bailout. Nero was the first emperor to systematically debase the silver denarius. The denarius was the reserve currency of the ancient world, the standard by which all trade was measured for centuries. It had been nearly pure silver. Nero reduced the silver content to roughly 90%. It seemed like a small change, a minor adjustment. The immediate effect was a boom. The precedent was set. The Nero pivot was the ancient equivalent of abandoning the gold standard. By the time of Septimius Severus in the early 3rd century, the silver content had dropped to 50%. Therefore, the army had to be bailed out regardless of the cost to the rest of the economy. By the mid-3rd century, the denarius contained less than 5% silver. It was essentially a copper coin washed in a thin layer of silver that rubbed off after a few transactions. The result was catastrophic inflation, but it wasn't just that prices went up. The entire structure of the economy warped. Merchants refused to accept the coins at face value. They demanded payment in gold or goods. The complex trade networks that allowed Rome to feed its cities began to break down. A soldier's salary, which had once bought a farm upon retirement, now barely covered daily subsistence. This is the hidden cost of the bailout. It transfers wealth from the saver and the worker to the state and its closest dependents. Consider the life of a Roman merchant in 270 AD. Let's call him Marcus. He deals in olive oil and wine. Every time the emperor issues a new batch of coins to pay the legions, Marcus sees the value of his savings drop. He knows the new coins are worthless. He knows the silver is a lie, so he raises his prices. The emperor Diocletian eventually responds, not by fixing the money, but by blaming the merchant. In 301 AD, Diocletian issued the edict on maximum prices. It was a massive list of price controls, mandating the cost of everything, from wheat to lions for the arena. The penalty for violation was death. The government argued that greedy speculators were causing inflation. They argued that the bailouts were necessary for national security. But the arithmetic is merciless. You cannot legislate the value of money. The result of the price controls was shortages. Goods disappeared from the markets. Marcus stopped selling olive oil because the mandated price was lower than his cost. The economy moved to the black market. The complex urbanized society of Rome began to de-urbanize. People fled the cities to the countryside, seeking the protection of large landholders where they could work for food, not money. This was the beginning of serfdom. The bailout of the Roman state ultimately required the enslavement of the Roman people. The middle class was wiped out, priced out of existence by the inflation created to save the state, just like the Roman emperors who diluted their silver to pay the legions. The Spanish Empire in the 16th and 17th centuries found a different way to fake prosperity. They didn't need to clip coins because they had stumbled upon the greatest source of easy money in history, the silver mines of the Americas. The Spanish Empire, under the Habsburgs, was the superpower of its age. It controlled Europe, the Americas, and trade routes to Asia. But maintaining this global hegemony was incredibly expensive. The wars against France, the Ottomans, and the Protestants in the Netherlands drained the treasury faster than taxes could refill it. Under Charles V and his son Philip II, the Spanish crown was constantly on the verge of insolvency. Their solution was the treasure fleet. Every year ships laden with silver from Potosi and Zacatecas arrived in Seville. This was the ultimate bailout. It was a divine injection of liquidity. The Spanish monarchs viewed this silver as wealth. They believed they were rich, but they were making a critical error in economic logic. They were confusing money with capital. Money is a medium of exchange. Capital is productive capacity. Spain used its silver to buy goods from the rest of Europe, to pay mercenaries, and to fund court extravagance. They did not invest in their own industry. They did not build a productive base. They simply spent. The result was the price revolution. The massive influx of silver did not make Spain wealthy, it made Spain expensive. Prices in Spain skyrocketed, rising much faster than in England or France. Spanish goods became uncompetitive. Why build a textile factory in Toledo when you can just buy cheaper cloth from Flanders with your American silver? The Spanish domestic economy hollowed out. The Dutch disease, as economists call it today, ravaged the Iberian Peninsula centuries before the term existed. The easy money acted as a sedative masking the structural rot of the empire. Consider the plight of a weaver in Segovia in 1590. His costs are rising. The wool he needs is more expensive because Spanish wool is being exported to foreign manufacturers who can pay more. The bread he eats costs 4 times what it did in his grandfather's time. Yet the king is the richest man in the world. The king is fighting wars on 3 continents. The king is bailing out the Catholic Church and the aristocracy. But the weaver is being crushed. The silver that flows into Seville flows right out again to pay German bankers and Italian arms dealers. It touches Spain only long enough to bid up the price of bread. The Spanish crown relied so heavily on this external bailout that they began to borrow against future silver shipments. They issued giros or bonds pledging the next year's treasure fleet to pay today's debts. This is the classic Keynesian trap, before Keynes stimulating demand today with resources from tomorrow. But the fleets were sometimes delayed by storms or pirates, and the wars always cost more than expected. The result was a series of spectacular sovereign defaults. Think about what that means. The richest empire in the world, literally swimming in silver, went broke 6 times in a century. Each time the crown restructured its debt. This usually meant ruining the bankers and seizing assets. It meant the bailout of the crown was paid for by the confiscation of private wealth. The social impact was profound. The landed aristocracy who owned the land and the rents were protected from inflation. Wages could not keep up with the cost of living. Spanish middle class, which had been burgeoning in the late 15th century, withered away. Spain became a nation of very rich nobles and very poor beggars, with a bloated bureaucracy in the middle. The bailout of the imperial ambitions destroyed the economic vitality of the nation for centuries. The illusion of wealth created by the silver mines allowed Spain to avoid necessary reforms until it was too late. They chose the comfortable decline of the bailout over the hard work of production. Just like the Spanish relied on New World silver to paper over their deficits, the Weimar Republic in Germany relied on the printing press to escape the crushing reality of defeat. The Weimar hyperinflation of 1923 is often cited but rarely understood in its mechanics. They believed they would win quickly and make the Allies pay the bill. They were saddled with massive domestic war debt, and following the Treaty of Versailles, crushing reparations payments owed in gold or foreign currency. It faced threats from communists on the left and nationalists on the right. It could not politically survive if it imposed the austerity necessary to pay its debts honestly. Raising taxes would cause a revolt. The government would issue treasury bills. The commercial banks would buy them. Foreigners flocked to Berlin to buy cheap goods. It was a stimulus-led boom. But the distortion was building. The currency was losing value slowly, at first then rapidly. The flight from money began. People realized that holding cash was a losing proposition. They bought anything tangible: pianos, machinery, real estate, foreign currency. The velocity of money exploded. This was the ultimate Keynesian stimulus, paying people to produce nothing. The printing presses ran 24 hours a day. Consider a widow who had patriotically invested her life savings in German war bonds in 1914. Let us say she had 100,000 marks, a fortune that could have bought a large house and provided a comfortable retirement. The bailout of the state and the unions was paid for by the complete expropriation of the saver. Their prudent behavior was punished with total poverty. Conversely, those who had debt were bailed out. Industrialists who had borrowed millions to buy factories saw their debts wiped out. A mortgage that took a lifetime to pay off could be settled for the price of a newspaper. This massive transfer of wealth turned society upside down. It destroyed the moral foundation of the economy. It taught a generation that saving is for fools, and that gambling and debt are the path to riches. The chaos of 1923 did not just destroy the economy, it destroyed the German people's faith in democracy and liberal institutions. The psychological trauma of the hyperinflation paved the way for extremism. They had been hollowed out by the bailout of 1923. But the seeds of complacency are sown here. Politicians and central bankers begin to believe they have mastered the economic cycle. At first, it seems manageable. A natural correction would be a painful recession, a clearing of bad debt, and a restructuring of the economy. They claim that without immediate massive state intervention, civilization will collapse. They cut interest rates to zero. They print money. They buy assets. They guarantee deposits. They bail out the too big to fail institutions. The public cheers because the immediate pain is dulled. The recession is short. The stock market recovers. Stage 5 is the distortion. The easy money flows into the system, but it does not flow evenly. It flows first to the financial sector, to the asset holders. This creates asset bubbles. Housing prices soar. The poor and the middle class see their cost of living rise while their wages stagnate. The currency begins to lose its purchasing power, but the government manipulates the CPI data to hide the true extent of inflation stage is the fracture. The inequality created by the bailout reaches a breaking point. The middle class realizes the game is rigged. They can no longer afford a home. They can no longer save for retirement. Social unrest explodes. Strikes, protests, and political polarization become the norm. The populace demands more bailouts, more stimulus, more free money to compensate for the inflation caused by the previous bailouts. The politicians trapped oblige. They print more, the cycle accelerates. Stage 7 is the reckoning. The trust in the currency evaporates. Bond market revolts. Foreign lenders stop buying the debt. The government is forced to choose between hyperinflation or a total default. The economy collapses not because of a lack of money, but because money has lost its meaning. The system resets usually through a new currency, a gold revaluation, or a totalitarian takeover. Just like Rome, just like Spain, just like Weimar, we are walking through these stages right now. The mapping is precise. Stage 1 was the post-World War II boom, the Pax Americana stage. 2 was the expansion of the welfare state and the military-industrial complex from the 1960s to the 1990s. Stage 3 was the 2008 financial crisis. That was the moment the private debt bubble burst. Stage 4 was the response to 2008 and subsequently 2020. We saw the greatest unleash of fiscal and monetary power in human history. Quantitative easing, zero interest rate policy. The government bought mortgages, corporate bonds, and ETFs. The balance sheet of the Federal Reserve exploded from under $1 trillion to nearly $9 trillion. They bailed out the banks, the airlines, the insurers, and the bond market. We are currently deep in Stage 5 and transitioning into Stage 6. The distortion is undeniable. Look at the housing market. In many Western nations, the average house earns more in appreciation than the average worker earns in wages. This is not wealth. This is debasement. The stock market has decoupled from GDP. We have seen the rise of zombie companies, firms that cannot even pay the interest on their debt from their profits, yet they survive because money is free. The fracture is visible in every headline. The populist uprisings, the demand for universal basic income, the strikes, the anger at elites. This is the direct result of the Cantillon effect, the economic law that says those close to the money printer get rich while those furthest away get inflation. The bailout of Wall Street was paid for by the stagnation of Main Street. Some economists argue that this time is different. They say that because the U.S. dollar is the world reserve currency, there is no limit to the borrowing. They argue that as long as inflation is managed, the debt doesn't matter. They point to Japan as proof that you can print forever without consequences. But this argument ignores the incentives and the scale. Japan had a massive savings pool and a trade surplus. The U.S. has a massive deficit and a negative savings rate. Furthermore, the exorbitant privilege of the dollar is not a law of physics. It is a matter of trust. We are seeing central banks around the world buying gold at a record pace. They are positioning themselves for the end of the dollar hegemony. The incentive for the U.S. government is to inflate away the debt. With debt to GDP over 120%, they cannot raise interest rates to a real positive level without bankrupting the Treasury. The only path left is financial repression, keeping interest rates below inflation to slowly steal the value of the debt from the bondholders. This is a slow-motion default. The endgame approaches in one of three ways. The first is controlled decline. This is the soft landing that central bankers dream of but rarely achieve. It involves decades of high inflation and low growth stagflation. Think of the British Empire after 1945, rationing capital controls, currency devaluations, and a slow slide into irrelevance. The standard of living drops, but the system doesn't explode. The government manages the poverty. The second is chaotic collapse. This happens when the bond market vigilantes wake up. If the world suddenly refuses to fund the U.S. deficit, the dollar crashes, import prices skyrocket. The supply chain breaks. This is the Weimar or Venezuela scenario. It usually leads to authoritarianism, as the public demands order at any price. The third is reset and restructure. This is the most likely outcome for the current global system. It involves a formal devaluation of the currency against hard assets. A Bretton Woods 20 governments might revalue gold to $20,000 or $50,000 an ounce to recapitalize their balance sheets. Or they may introduce central bank digital currencies, CBDCs, to lock down capital and enforce negative interest rates. This is a bail-in where the unaware. Currency itself is reprogrammed to prevent escape. In 1948, Germany replaced the worthless Reichsmark with the Deutschmark. Individuals were allowed to exchange a limited amount of cash at a 11 rate, but larger savings were converted at 101 or wiped out entirely. It was a reset. The economy recovered, but the savers were sacrificed. The only variable is timing and pain. The system is mathematically insolvent. The bailouts have not fixed the problem. They have only increased the size of the eventual write-down. The debt cannot be paid in real terms. It will be defaulted on either through honest refusal to pay or dishonest inflation. You cannot change the macro cycle. You cannot stop the printing press, but you can position yourself. You can step out of the blast radius. This means education. It means understanding the difference between currency and money. It means resilience, owning things that cannot be printed. It means paying attention to the data, not the rhetoric. The era of the bailout is ending. The era of consequences is beginning. Subscribe.